From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, investors pricing in more rate hikes. Chairman Powell offering qualified pushback as inflation expectations continue to build. We begin with the big issue, bringing forward rate hike bets.
At this point, we're thinking 2 rate hikes next year.
The market already is anticipating a faster or sort of quicker pace of tightening.
Talking about rate hikes sooner than once anticipated.
You do have all this upward price pressure.
The Fed is going to be late to the game.
And you're going to have to see the Fed do something.
The writing is clear for them.
Central banks have very little latitude and flexibility to say, no, we really cannot hike.
We were once talking about end of 2022, early 2023.
We now saw the first rate hike being priced into the market in September 2022.
If you move rate hikes from December up a little bit.
To get 2 hikes in would probably require June and SEP, or maybe SEP and DEC.
And all of a sudden you end tapering mid-2022.
Things getting pulled forward.
That's putting it pretty close.
Joining us now to discuss Franklin Templeton's Sonali Desai, PGIM's Mike Collins and Zach Griffiths of Wells Fargo. Sonali, let's begin with you. How much daylight is there between this market and this Federal Reserve?
So I think that the market tends to swing from one direction to the other direction, pretty extreme. You know that, Jonathan, you know that we've been around talking about more inflation than the market has been pricing for a very long time. I do think inflation continues to have legs. Therefore, and it started becoming a political issue as well. So I do think that the Fed is likely to raise probably sooner than we were anticipating, certainly a few weeks ago as the market, and potentially more.
You're not alone. Bank of America's with you. They pulled forward their rate hike call. This was Michelle Meyer of Bank of America a little bit earlier this morning. We raise our inflation outlook on supply side constraints and stronger rents and pull forward the first rate hike. They're going for 4Q22. Mike Collins, where are you?
We are kind of sticking with our guns, Jonathan. I mean, the markets are playing a game of cat and mouse here with the Fed, right? The markets kind of usually race ahead of the Fed, pricing more hikes, and then the Fed's dots actually caught up, and now the markets are kind of racing ahead again of the Fed. The markets are pricing in 2 hikes next year, 3 in 23, and then another 1 or 2 hikes each year after that to get to about a 2% funds rate, and we're generally taking the under. Right? We think there's a really good chance in a year from now, and certainly in 2 years from now, Jonathan, just as the Fed is starting to move into action and to lift off the funds rate, that demand is a lot weaker and supply is coming online and inflation and growth are both rolling over.
So you're pushing back against where this market is priced right now, Mike. That's right?
I'm looking at that 5-year TIPS, Jonathan. It hit 3%, meaning the break-even inflation rate that's priced into the bond market was 3% a year. For 5 years, we're taking the under.
Okay. Zach, where are you?
So we definitely see a gap between where the market is and when we actually expect the Fed to hike. We have mid-2023 liftoff. I'd say the risks to that call are certainly skewed towards sooner than later. But if you think about when the Fed tapered in 2013 and 2014, it finished up in October of 2014. It didn't hike until December 2015, but we largely consider that rate hiking cycle to have begun in December 2016 as they waited a whole year before they hiked again. So I think to expect the timeline this time around to be quicker as the recovery has been much faster makes sense to us, but we still think there's going to be a bit of daylight between when they finish tapering up in mid-2022 and when they ultimately start hiking rates.
So there's some subtle differences between the three of you. Let's pick up on one of them. It's the outlook for inflation. Mike Collins expecting this to fade pretty quickly through next year. Mike, we can get a bit more detail from you on that in just a moment. So I know that you think this will be a lot more persistent. The last time we caught up with you through the summer, you were beating that drum pretty hard. What is it that separates you from, say, the likes of Mike Collins at the moment?
I think probably a couple of things. One is that, for example, when we talk about what happened previously, we were not looking at it against a backdrop where consumers had a massive quantity of pent-up savings ready to go when they can. We were not looking at it at a time where fiscal, after 1.9 trillion this year, we're still debating how much more fiscal expansion we're going to get over the next few years. And something to keep in mind, while the Fed tapers, it's still expansionary. they're buying every single month, right? So we're still looking at expansionary monetary policy. You've got all this coming together. And I think you'd need to have some pretty dramatic decline in growth outlooks for this to meaningfully impact inflation. And if I think about what the inflation outlook looks like, a lot of these supply chain bottlenecks seem to be running for a lot longer. The chips were supposed to be 3 months, then 6 months, now 2 years. I think this is going to have an impact.
Mike Collins, do you need growth to slow down that quickly to achieve what Sonali Desai described?
I think you need a combination of demand coming down and supply going up, and they're both going to happen. Granted, the supply coming up is happening much more slowly than the markets thought, than we would have thought, right? Every day it seems like there's a new type of bottleneck hitting, right? This week it's natural gas prices in Europe. But just today, the Ukraine is negotiating with Russia to provide a big discount to pipe natural gas into Europe to provide some supply. So the markets will find a way, right? Supply will eventually come online. I think the big surprise will be how quickly supply and demand adjust. And a year from now, we might be talking about disinflationary trends coming back.
So 10's at 165. Mike, you say if we get to 2%, back up the truck and add duration. What does 165, 170 mean to you, Mike?
Yeah, that's flashing value for sure, John. There's a lot of value in long rates here, 10s and out. The 30 years, we've kind of loved it. I was looking at my old notes being on the show years ago, and I said, a yield above 2% on a 30-year treasury would be a museum piece someday. And here we are, we're all the way back to 210 or so. And today you're seeing the price action, right? I mean, the front end is selling off a little bit, and the long end is rallying hard because the markets know if the Fed hikes too aggressively, that's the policy mistake, right? They're going to shut down the global economy, and inflation and growth will fall.
I remember the question that led to that answer, Mike Collins. I asked you how you'd look back on this bond market in 10 years, looking back 10 years with rates this low. And you said you will wish you had brought the 10-year where it was trading at that point. We're not going back there. Zach, do you disagree to some degree?
Yeah, we disagree. Our outlook is yields are going to continue rising from here, and that coincides with our outlook for the Fed to move slowly with respect to a rate hike. So we think that keeps the front end anchored, and perhaps you have some of this somewhat aggressive repricing come out of the market and pull down front end yields a bit from where we are today. But we think that with policy remaining accommodative through the middle of next year and the policy rate remaining very low through even the middle of 2023, we think that leaves room for the back end of the curve to continue rising and even get a little bit of a boost here in the next couple of weeks as we expect the Fed to announce a taper on November 3rd.
We had a look at 170 this week. Yesterday at the close, right now 10's at 165, 2's at 46, had a little look at 50 basis points. So now you're on the other side of the trade to Mike Collins. Mike's a buyer here potentially at 165 on 10's. What is the limit for this 10-year yield in your mind? At what point does it become self-limiting, some form of sell-off in the Treasury market? How high can this yield go?
Okay, if we're looking at fundamentals, I think the yield can go very high because we are looking, and from my perspective, at more durable inflation. There's absolutely no reason for the US to have negative real rates, and we do. So I look at that, and I don't see it being self-limiting. If we're talking about the Fed stepping in, for example, to buy the long end, to keep it suppressed if it sees too rapid a sell-off, keep in mind that's expansionary as well. Doesn't help you much on the inflation front if the Fed decides at some stage to step back in and start buying the long end, which ultimately I think is going to be needed if you want to keep the long end suppressed at about 2.25, 2.3. If you want the long end to stay there, you're going to need to take more actions unless inflation just plummets, which we're not seeing at this point.
One thing that has confused me, Sonali, and Mike Collins, I'd love your view on this. It's confused others too. I caught up with Columbia Threadneedle earlier on this morning, and they pointed out that the front end's pricing more hikes and the long end's pricing higher inflation. Mike, can you reconcile those two things? Is that a disconnect? Do they complement each other? Does that make sense to you?
Yeah, I think that real yield that you reference and the name of the show aptly is kind of the residual of all of this, right? As inflation expectations have gone up, long rates actually haven't gone up that much. They're kind of bouncing around these high levels, and they've been relatively range bound. The curve has flattened a lot. in the last few weeks and months. So the markets are pricing in higher funds rate. But as the Fed hikes rates, as those rate hikes become aggressive, again, it means slower growth and slower inflation. That real yield, and I'll take the other side, is going to be negative probably for the rest of our lives, right? You should not earn a positive return over inflation for sitting in cash and T-bills. That's not the world we live in, right? There's 17 odd trillion in cash sitting in the bank at zero, probably because that rate's too high, right? If that was 2.5, everybody would sell all their stocks and bonds and real estate and put it in cash at 2.5. It's too high of a rate.
Just to dissect a little bit of this a little bit more, Zach, just to wrap things up. People have talked about break-evens a lot this week, and I often hear a lot of people talking about the market-implied rate of inflation. When you think about what break-evens are, and you just define them as subtracting the real yield of the inflation-linked curve from the nominal yield of the same maturity, I'm just wondering, does that really give you a clean read on what market-based expectations of inflation is? If I'm buying tips, is it really... Do you know what I'm getting at here, Zach? Does that make sense to you? Is that really a clean read on a market-based inflation expectations? Do you think that we're covering this in the wrong way in the media, in markets, elsewhere?
Yeah, that's a great point, Jonathan. I think in the sense that it's really it's not our only measure of market-based inflation. I guess you could look at inflation swaps, and they're all pointing to much higher inflation than what we've been used to over the past decade. But we think it makes sense, and from an economic fundamental perspective, we have inflation remaining near 4% on core CPI next year, and as far as PCE is concerned, it's around 3.5%. But looking past that, we have it coming back down toward the more comfortable 2% level that the Fed has wanted to see, as part of its mandate for a long time now. So I think as far as some of these measures hitting much higher rates of inflation expectations, it shows a large demand, I think, for real yields or at least inflation protection. And we think that that's actually going to come off as the Fed starts to provide a little bit less support. We think the taper has a bigger impact on real yields, but we don't expect inflation expectations to collapse. So we think that real yields move higher, and that pushes nominal yields with it.
Is it a hedge or is it a bet? They're two different things, aren't they? Guys, you're going to be sticking with me. Thank you very much for being with us. Up next, the auction block. Another steady week of junk bond issuance in the United States. That conversation is coming up next. From New York, this is Bloomberg. Live from New York, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now to head to the auction block, where we begin over in Europe with issuers across all sectors raising 34 billion euros this week, a record-setting green sovereign offering from the UK. Among the highlights, in the US, the Treasury selling 20-year notes yielding 2.1%. The auction missing the mark by the widest margin since sales of the securities began last year. And cruise operator Carnival returning to the junk bond market this week, upsizing its offer and pushing weekly supply close to $8 billion. Mike Collins, Zach Griffiths, back with us. Zach, I don't know why I always butcher your name. Zach Griffiths is still with us. It's such an easy one too. Mike, let's start here. Bank of America coming out with stat of the week for me. Turkey cut rates this week. It's the 1,000th rate cut since Lehman. And they count that 1 every 3 trading days since Lehman went under, we've had a rate cut. Mike, I wonder whether it's the last, because outside of EM, all we've seen is hikes. Can you tell me what's happening in emerging markets at the moment, Mike?
Well, China is going to be joining the rate cut story, I think, right? I mean, China is always the big story in emerging markets, Jonathan, and they are, unfortunately, slowing really quickly, right? And it's not just the property sector. Some of it is secular. Some of it is tighter regulations across the board. But certainly their property sector is gigantic. It is outsized relative to every other measure of economic activity, and it's highly levered as well. And as the air comes out of that, their growth will slow. Their rates are still at 3%. They're probably going to have to come down. But away from that, seems like every other central bank in the world, Jonathan, is going the other way, right? Turkey is a little off the chart here in terms of their policies, but every other central bank is hiking rates. They don't know how to fight inflation. They have one tool: it's to hike rates, right? And again, I think the Fed, by hiking rates, is not going to solve a shortage of materials, a shortage of supply bottlenecks. They can't solve that by hiking rates. So they're really going to have a dilemma.
What's happening in EM right now, I think it's really important. We had a 75 basis point hike from Russia. Looking ahead to next week, Zach, Morgan Stanley, 125 basis point hike. They're looking for that from Brazil. UBS, 150 basis point hike. from Brazil. That's what they're looking for next week. Zach, from your perspective, when does this start to matter to the global economy, to DM specifically? Rate hikes, monster rate hikes in really big economies.
Yeah, we think it's a big theme, and it's going to matter sooner than later. And I would actually switch focus to the Bank of Canada, which also has a meeting next week. We expect them to announce the taper, and will really be focused on their forward guidance as to when they might actually begin hiking rates. I'd say the big one earlier this week was the Bank of England coming out and essentially showing that they're going to hike rates in November, almost a done deal. That's on November 4th, and we expect the Fed to taper on November 3rd. So I think that you're seeing a big shift globally. It's going to start to matter, but you do have, at least with respect to the U.S. and domestic demand that we see here, a very sturdy backdrop. So we expect the economy to remain on solid footing, but much tighter policy is definitely a big driver of why we see rates moving higher in the near term.
Hugh Pill, speaking to the Financial Times, the chief economist over at the Bank of England, calling November 4th a live meeting for the Bank of England. What's fascinating about that interview, when you read through it in the FT, Mike Collins, further down, away from the big flashy headline about a live meeting on November 4th, he's essentially asked by the Financial Times whether he would consider going back to the pre-pandemic level of 75 basis points, and they're still committed to this idea of transitory. So the journey might start sooner, but ultimately for the Bank of England, the path is still shallow. And Mike, it raised an important question for me. Even the likes of the Bank of England right now, who are thinking about hiking, they're still thinking about a transitory inflation backdrop. And I wonder, from your perspective, have we broken out of this low inflation mindset at these central banks yet?
You know, we apparently haven't. In fact, Jerome Powell was on the tape this morning talking about inflation expectations still going back toward 2% over the next couple of years, Jonathan. So I think what the Bank of England and the Fed and other central banks will do in the developed world is they'll try to raise rates. They'll raise rates a little bit, and they'll be surprised at how much financial conditions tighten as a result of that. You're seeing it in emerging markets. You're going to see it in the developed markets. With all this new debt we have, right? We had a lot of debt in the world as it was. When COVID hit, those debt levels went straight up. So every quarter point hike by any central bank has a magnified impact on financial conditions. So maybe the Fed hikes up to 1% and they get stopped out. Maybe the Bank of England hikes once or twice and gets stopped out. So that's a very likely scenario.
We had some technical difficulties with Sonali, Desai and Franklin Templeton. Sonali, I'm pleased to say, is back with us for some final comments. Sonali, you haven't missed much as far as your thoughts are concerned, because Mike Collins was just talking about our tolerance for higher interest rates, and that really picks up on where you left things. You think we can take higher interest rates? You think sell-offs in bond markets won't be self-limiting? What separates you and Mike Collins?
So I think I just caught the end of Mike's comments, and I think right now, if I can actually go back to something which we were talking about before the break briefly, the inconsistency between the short end and the long end. So the long end sells off despite the fact that you have the short end pricing in hikes. I think the short end probably isn't pricing in as many hikes as would lead the market to believe that the long end is going to come down. That's number one. Number two, if I look at what the Fed is saying or what the Bank of England is saying, I would only say one thing. They would say that, wouldn't they? Now, no, seriously, in the sense that if you had Jerome Powell saying he did not believe that inflation expectations were going to come back, someone like me is going to say, well, what are you doing? Why do you have rates as low as they are? Why do we have such expansionary monetary policy if you don't believe that inflation is going to come back down? So in a sense, more than being self-limiting, I think central bankers are talking their book. All of them are still in very expansionary territory despite inflation. And unless they believe that inflation is going to come down, their policy is completely inappropriate. So I actually do not agree with Mike Collins on this.
Like fund managers just talking their books, and I would have thought it. Central bankers and fund managers have something
seriously,
unbelievable.
Isn't that incredible? I'm talking mine, and I think they're talking theirs.
I think Mike's talking his too. Mike Collins, final word on credit. Just on investment grade credit, UBS pointing out they think we'll have a negative year. Only a few more months to go in the United States for investment grade credit to have a negative year. But it's interesting to me, Mike, that we could have a negative year in credit in investment grade, and this S&P 500's up 20% year to date. How rare is that, Mike?
Jonathan, it's all the duration component of the credit. If you just look at the credit spread, the excess return of those corporate bonds versus government bonds, it's actually been a huge year. So they've actually been really correlated with stocks. Earnings are great. Fundamentals are great. Companies are delevering. They're getting upgraded faster than downgraded. We're actually at a really incredible part of the cycle where we're seeing a tremendous rate of credit quality improvement, and that's being reflected in the outperformance of corporate bonds, high yield bonds versus government bonds, and that's really the key point.
Mike Collins sticking with us. Sonali Desai, Zach Griffiths. I have to say it's good that Sonali and Mike are kind of separate and in different places because I don't know what would happen. Still ahead, the final spread the week ahead featuring US GDP and a host of global rate decisions. That conversation up next. This is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg, a real yield. It's time now for the final spread the week ahead. Coming up, economic data in focus with the Fed entering its quiet period. New home sales and consumer confidence coming on Tuesday. Plus, the Treasury auctioning off 5- and 7-year notes throughout the week. US GDP coming up on Thursday. We get rate decisions from the ECB and the BOJ. And we round out the week on Friday with US personal income and spending numbers. Now to the final round, the rapid fire round. 3 quick questions, 3 quick answers. Does inflation end next year with a 2 handle, a 3 or a 4? One-word answers, please. So now to you first. 2, 3 or 4?
I'm going to go with 3.
Mike Collins.
2.
Zach.
3.
Rate hikes from the Fed next year, 25, 50 or none at all? 25, 50 or none? Mike.
50.
Zach.
None.
So no.
Probably 25, I'm thinking.
And an easy one because we're all friends. The Bank of England says it's a live meeting. Do we get a hike at the next meeting? Mike Collins.
Yes.
Zach.
Yes, we do.
So no.
Yes.
Thanks for being with us, guys. I enjoyed this show. Thank you very much. Sonali Desai, Mike Collins, Zach Griffiths, thank you very much. And Zach, I got the name right at the end there. From New York City, that does it for us. Same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.